Stop following the herd into overpriced markets. The real wealth in 2026 won't be made in Florida or Texas. While the masses fight over slim margins and saturated markets in the Sun Belt, the smart money is quietly shifting. We've spent the last 12 months analyzing migration data, corporate relocation trends, and cap rate shifts across 100 different US markets. Our approach isn't based on hype, it's based on the math of where people are actually moving and where the jobs are landing. Today, we are unveiling the 2026 migration map. We're breaking down 5 underrated Midwest cities poised for explosive growth. These are markets where you can still secure high cash flow, low entry costs, and massive long-term appreciation. If you're a high-net-worth investor looking to scale a passive income portfolio without the Sun Belt headache, this is your blueprint. Most investors are doing the exact same thing right now. They're chasing the Sun Belt dream: Florida, Texas, Arizona. On paper, it looks obvious. Everyone's moving there, right? But here's the reality. The market already knows that. The growth is already baked into the price. You're now fighting 20 other cash buyers for a property that's already overpriced. Your cap rates are shrinking. Your margins are razor thin. You aren't investing for growth anymore. You're just paying a premium to be part of the herd. It's the safe market trap. You feel secure because everyone is talking about it. But while you're fighting for scraps in Austin or Tampa, the high net worth players are quietly pivoting. They aren't looking at where people were moving in 2021. They're analyzing the migration map for 2026. If you keep following the trend, you're not leading, you're lagging. And in real estate, lagging means leaving 6 figures of equity on the table. The safe bets have become the riskiest plays in the portfolio. The bubble is stretching and the entry points are gone. It's time to stop chasing the hype and start chasing the yield. Here is the cold, hard truth. The Sun Belt is saturated. Florida and Texas were the gold mines of the last decade, but for 2026, the risk-to-reward ratio has flipped. Sky-high insurance premiums and peaked valuations are eating your margins alive. To build real wealth now, you have to look where others aren't. You need the 2026 migration map. We are talking about cities with low entry costs, diversified economies, and a massive influx of remote professionals seeking affordability. Let's dive into the 5 Midwest cities poised for explosive growth. First up, Columbus, Ohio. This isn't just a college town anymore. With the massive Intel chip plant investment, Columbus is becoming a global tech hub. We're seeing a surge in high-earning engineers moving in. This creates a perfect storm for workforce housing and luxury rentals. If you use a tool like PropStream, you can see the heat maps for rental demand already spiking in the outskirts. Next, Indianapolis, Indiana. Indy is the logistics capital of the US. It's the crossroads of America. While others chase flashy markets, Indy offers incredible cash flow. It's a landlord's paradise because of the stable rental market and low property taxes. Pro tip, run your numbers through Deal Check before buying. You'll find that the cap rates here often double what you'd see in Austin or Miami. Third, Kansas City, Missouri. KC is the sleeper hit of 2026. They've invested billions into infrastructure and sports complexes. This is attracting a younger, professional demographic that wants a city feel without the coastal price tag. It's a prime spot for long-term appreciation. Fourth, Grand Rapids, Michigan. Look at the medical mile. Grand Rapids has a powerhouse healthcare sector that provides a recession-proof tenant base. When you have doctors and nurses as your renters, your vacancy rates drop to near zero. Finally, Omaha, Nebraska. Omaha is the fortress of the Midwest. It's home to Fortune 500 companies and has some of the lowest volatility in the country. It's the ultimate play for high-net-worth individuals looking to preserve capital while earning a steady yield. Now I know what you're thinking. I don't have time to manage a property in Nebraska. That's where the strategy shifts. You don't have to be a landlord to profit from this migration. If you want 100% passive exposure to these types of growth markets without the 3 a.m. phone calls about a leaky toilet, look into rates. Platforms like Fundrise allow you to diversify into institutional-grade real estate with a fraction of the capital. Whether you go the direct route with PropStream and Deal Check or the passive route with Fundrise, the goal is the same. Stop following the herd. Start following the data. Now, finding these Midwest gems requires more than a Google search. You need a data-driven edge. That's why I use PropStream to pinpoint high-equity owners and distressed properties before they ever hit the MLS. Once I have a lead, I run the numbers through Deal Check. If the ROI doesn't hit my target, I pass. No emotions, just math. Now, if you want the growth of these markets without the headache of being a landlord, Fundrise is the play. It lets you invest in institutional-grade real estate with a fraction of the capital. The result? A diversified portfolio that scales while you sleep. Stop guessing and start calculating. Check the links in the description to get started with PropStream, DealCheck, and Fundrise. Build your 2026 wealth map today.